You ready for the Fed to flip? Well, be careful what you wish for. Let me show you what I mean. We'll get into inflation today, show you what the Federal Reserve is up to. I'm going to give you so many charts, it's going to make your head spin. The first thing I wanted to look at was the inflation data itself. So we're just going to go one chart after the other. The second thing is why the Fed is not ready to flip. Okay, and this is important because interest rates at this level right now are already high, but the markets believe that there will be a turning point coming later this year. That doesn't look likely. Let's begin with this. Consumer prices rose 8.5% in July, less than expected, as inflation pressures ease a bit. And what's important to note here is that this is year-over-year gains. So the gains are still there. It's just less gain than what we had previously. I think that's really important to understand because they're suggesting that it's just down, but we're talking year over year, and last year was already excessive. Last year was already high. So 8.5% is a big number, but that's not the way the market perceives it. They believe this is going to allow the Federal Reserve to turn things around and simply pivot, and that therefore this would mean this is the right time to buy stocks. So what the players are doing is they're starting to buy now, saying, hey, they're gonna do this by the end of the year. I'll get in now, can't lose much. This is just showing you here year over year and month over month. And while we are way, way off of where we were historically and even not that long ago, it has started to come down. Looking at this, you could see this is the CPI, less food and energy. There are different measurements of inflation, but it seems that on many levels, this has come down according to their official stats, okay? And then you break it down. You look at services and goods and food and energy and so on, and you can kind of see what's been happening. Services have been rising. Here, however, if you look at other things like, energy, for instance, that has come off its peak. But again, this is still very high, but that remains for another day. You can just see the month over month what has happened here. So this has been a big change month over month. There's no doubt about that. When you look at the top 5 subcomponent contributors, you see right now, of course, we've got things like gasoline, which has come down. Remember, it was at, what was it, on national average, over $5 a gallon, even higher, $6 a gallon or something. Looking at this just shows us that we have seen a big change. Does that mean that the Federal Reserve can stop their policies? I'll show you more about that in a second here. Look at this. Shelter and rent inflation year over year has just gone berserk. And people know this because the rates at which they are paying today is unlike anything we've seen before. You try to compare price to rent ratios, I mean, it's just out of whack. But here we have it anyway, looking at it, going up, and then here, the US real average weekly earnings year over year, again, in the red. Because despite people getting raises, despite people getting more money from the government and all these things that have happened over the last couple of years, the truth is inflation is much more powerful. And then you take the real examples, and that is number 1, egg prices in the US jump 47% as food inflation hits 1979 high. Frozen pizza, bacon, and ice cream also surge in July. But you take different commodities, you look at different foods, packaged foods, produce, whatever the case may be. And in general, things have moved up considerably. Now I can look at a particular product or an index. CPI, less food and energy. Oh, it's 5.2%. It's down 1%. And these don't really matter. What matters is if you're buying those eggs and they went up 47%, then you have a problem. Isn't that the way it goes? So let's get into this. Big thing. I want to show you something. Because most of the people that are involved today believe there will be a pivot coming later this year. Is that the case? Well, I'm going to be covering each and every one of those details, so you definitely want to hit that subscribe button down below. I'm going to show you that, and I will give you some good stuff in the next video after this one, so you want to be subscribed. Take a look. If monthly inflation is 0 for the remainder of 2022, which is highly unlikely, CPI will only fall to 5.43%. Yes, that's much better than 9.1%, but it's still well above the Fed's 2% target. The other more likely scenarios are too high to allow the Fed to halt its fight against inflation. Do you see? So even if we see interest or inflation rates coming down every month, coming down, it's still at a high level. So the Federal Reserve will still have to continue their hikes this year. But you don't have to believe Real Investment Advice. Great website, by the way. You could believe the Federal Reserve. Do you want to believe them? Well, I guess that, depends how you look at it. Fed leaders, unswayed by softer CPI, see rate hikes into 2023, including Kashkari, the guy who was saying we have to increase inflation. Well, now he seems to be changing his tune. You could see he wants 3.9% for the Fed funds rate by the end of the year and 4.4% by the end of 2023. Now, these people flip-flop like a bunch of pancakes. But anyway, I got to read this information to you, and we see how it evolves. Quote, I haven't seen anything that changes that, meaning the interest rate hikes. Even Charles Evans said, essentially, inflation remains unacceptably high. He said that he expects that we will be increasing rates the rest of the year and into next year to make sure inflation gets back to our 2% objective. And that is what we're talking about here. They have said over and over and over and over again, we want inflation at 2%. It's way off 2%. So is it going to be 2% by the end of the year? Seems very unlikely. Is it going to be 6%? Sure, could be. Could be 6% by the end of the year. And that's still, quote, unacceptably high. So they would have to increase interest rates. Now that they have to do it by 0.75%? No. They could do it by 0.5%. They could do it by 0.25%. That seems more likely. Many have said 0.5% at the next meeting in September, and then the remaining meetings will be 25 basis points or 0.25%. But nobody really knows. And if inflation starts to pick up again because of commodity shortages, because of anything else, well then, we could see things getting even hotter. It really all depends. One of the factors here that is not being discussed is that the 1970s, while it's not a mirror image of what we're seeing today, the 1970s taught us a lesson. And that is, you have to stifle the flames immediately or they will engulf everything, and then you have to take even more drastic measures. So it's better to pull the Band-Aid off and simply deal with the pain right away than have it linger for a longer period. It's just a matter of fact. Okay? Now I'm going to show you what's happening right now with Europe and with others. Just looking at the prices that people are paying, it's quite excessive. And I'll show you this first. European gas prices soar after Russia deepens supply cuts. Futures contracts hit 5-month high after Gazprom announces drop in flows. This is not what Europe needs right now. This is what happens when you get so dependent on it. I believe, according to what I've seen the stats, they've lessened the dependency on Russia by 50%. But the question is, were all these countries ready for a 50% cut just like that? Or are now people paying more than ever before? Oh yeah, you're going to punish Russia. You're going to punish them so bad that you're going to pay much more for your gas. Is that the way it works? Do you think Russia is necessarily hurting? They just say, hey, China, can you buy all our gas? Hey, and they just point to different countries. I mean, they don't seem to be getting hurt by all of this, at least what we see, because they didn't really take strong actions. They said, you got to make sure that you're using the US dollar. But if you don't want to, we're going to set up this different way and it's going to be all okay. Do you remember that? Remember I covered that? Oh, you're going to try and circumvent everybody with paying in rubles? Okay. That's okay. We totally accept that. No worries. In fact, our companies are going to deal with your companies in rubles and we'll make this little side exception for you and it's all good. I mean, come on. If you're going to try to send the message, I mean, it doesn't exactly seem like that's the message you want to send. Anyway, the great European energy crisis is now coming for your food. Energy rally is raising the cost of everything from bread to sugar. It's a double whammy for firms contending with material costs. This one right here, I've said it once, I've said it again. Europe is in the worst position possible. It's just the worst position possible. High debt load. You've got the burden of, trying to deal with all of these countries, one interest rate, one currency, so much bureaucracy and red tape. They've got all these different alphabet, institutions and, the EFSF, the ESM, all these new things that they create that try to fix the problems of what they created and never do. Europe's in a bad spot, okay? German economy to lose 265 billion in added value due to the war, high energy prices. Germany, which was such a strong powerhouse in so many different ways, is really taking a hit right now, being so dependent on Russia, seeing commodity prices rising, energy prices rising, and of course, this doesn't look good for the short to medium term. Who knows what will happen long term? Rental costs are rising at the fastest pace in more than 3 decades, surpassing a median of $2,000 per month, $2,000 a month for the first time ever, pushing rents above the levels that they were at in early 2020 in most major cities. So right now we are watching rents rising. We are watching inflation rates picking up from where they were a couple of years ago. We have seen interest rates rising. I mean, commodity price, everything is just out of whack. But people are paying more. That means they have less money to spend on other things. They're cutting their Netflix subscriptions. They're cutting their Peloton subscriptions. And all of this has a drag on those companies, which ultimately leads them to lay people off. I just pulled up that chart for you right now. You can see the corporate layoffs. If I zoom in, you've got Ford here, you've got Peloton, Carvana, all kinds, okay? Anyway, you're just seeing this. It depends on the company, depends on the institution, who's doing it, and so on. But I think it's important to face the music and try to understand where this is heading. What happens in the next cycle? Well, this is one very good example. We'll leave it off with this. Robot arms are replacing shelf stockers in Japan's stores. So you do not need people at the cashier anymore. Self-checkout. I just went to a store today, all self-checkout. Okay, maybe there was one cashier, but it was all self-checkouts. Okay, that's just the way it goes. You look at this, no need to stock the shelves anymore. You got the robots doing it. They're going to figure out a way to do all shipping using robots, automation, technology. These jobs are going away. So what does that mean? It means you are becoming subservient to the, those in control. And what are they going to do? They're going to offer you. They're going to make you a real offer, an offer you can't refuse. They're going to say, we got the central bank digital currency, all right? And we got this universal basic income. You want the universal basic income, you sign on to the central bank digital currency, and here you go. This is why I have told everybody for a very long time, since my very first book published January 2012. If you look at this and you realize, you got to understand, you can't rely on their systems. You need to be self-sufficient. You need to have a secondary source of income. You need to be able to have passive income coming through. You need a way to earn, a high income skill. You need that. You need skills, handy skills and so on, but you need a high income skill. It's so key. If you don't have those skills, you got to learn those skills today. So that's it. That's my message. I hope you appreciate it. If you're not subscribed already, you got to do so. 282,000 soon. We'll be at 282,000 subscribers. So thank you all for joining in. I'll see you on the next one. Take care.